Hi everyone, welcome back to the Corporate Finance and Valuation series. In this learning module 2, we're going to understand the difference between the direct method and the indirect method of preparing the cash flow statement. This is one of the most important accounting topics for valuation, financial modeling, and financial analysis because profits do not always equal cash. By the end of this lesson, you'll understand how companies convert accrual accounting into cash flow, why working capital account adjustments matter, and how analysts interpret operating cash flow in a real world situation. So let's get started. So, why cash flows matter more than you think? The income statement tells us whether a company is profitable, but it does not tell us whether the company is actually collecting cash. A company can report strong earnings while still facing liquidity problems. For example, imagine a company records a 50,000 sale on credit. Revenue increases immediately under accrual accounting, but no cash has been received yet. So the income statement looks strong, but the bank account remains unchanged. This is exactly why the cash flow statement matters. It helps us evaluate liquidity, cash generation, earnings quality, and whether profits are converting into real cash. So, key takeaway here is profitable companies can still go bankrupt if they run out of cash. The three sections of the cash flow statement. Every cash flow statement is divided into three sections under both IFRS and US GAAP. First is the operating activities. This includes cash generated from the company's core business operations, such as cash received from customers and cash paid to suppliers, employees, and tax authorities. Second, we have investing activities. These relate to long-term assets and investments, such as purchasing equipment, selling investments, or acquiring businesses. Third is financing activities. These involve raising capital or returning capital to investors, such as debt issuance, debt repayment, dividends, and share buybacks. Direct versus indirect method of preparing the operation cash flows is what we're going to be analyzing in depth in this section. Investing and financing sections are prepared the same way under both methods. So what is the direct method? The direct method reports actual operating cash inflows and outflows line by line. Instead of starting with net income, which we do in the indirect method, the company directly reports the cash received from customers, the cash paid to suppliers, cash paid for salaries, and taxes or interest paid in cash. Think of direct method like a cash basis income statement for operating activities. It clearly shows where cash came from and where it went during the period. Because of this transparency, accounting regulators like the FASB and the IASB actually prefer the direct method. However, despite being more intuitive, it is rarely used in practice because it is more costly and time consuming to prepare. Because the company is required to list all the sources of cash and all its uses of cash, hence the company prefers using the indirect method, as we'll see in the coming slides. So let's look at an example of a direct method. Suppose revenue in the income statement is $500,000. However, accounts receivable increased by $20,000 during the year. This means that customers owe more money than before, so the company has not yet collected all of the revenue in cash. So we calculate cash received from customers, which will equal $500,000 minus $20,000, which equals $480,000. This is because accounts receivable has increased, and we have not yet collected all of the revenue in cash. So part of the sales that we did, we have not yet collected the money. Now let's look at the cash paid to suppliers. The cost of goods sold is $200,000. Inventory increased by $10,000, meaning the company purchased additional inventory. Accounts payable increased by $5,000, meaning some purchases were financed or credit and not yet paid in cash. Hence, the total cash paid to suppliers is going to be $200,000 plus $10,000 minus $5,000, which equals $205,000. This gives us partial operating cash flow of $275,000 before salaries and taxes. Let's look at the indirect method. The indirect method starts with net income and then adjusts it to arrive at operating cash flow. The idea is simple. We begin with accrual-based profit, which is the net income, and convert it into actual cash generated. So there are three major steps that we follow. We add back non-cash expenses like depreciation, we adjust for working capital changes, and we remove accrual accounting distortions. So for example, depreciation reduces net income but does not reduce cash. Depreciation is a non-cash expense. Increase in receivables reduce cash collection because we are yet to collect the money from the sales that we have made on credit. And increase in payables delay cash payment. Increase in accounts payable is considered a source of cash. By not paying our suppliers, we're retaining the cash flow, which we can use for our own purposes. So the final result is the cash flow from operations. So let's look at an example of an indirect method. Here's a complete indirect method calculation. Every adjustment has a logical reason. Understanding the why behind each line item separates memorization from true comprehension. So let's look at the indirect method numerically. Suppose net income is $100,000. First, we add back depreciation of $15,000 because it is a non-cash expense. Next, accounts receivable increased by $20,000. That means revenue was recognized, but cash has not yet been collected, so we subtract it. Then accounts payable increased by $8,000. That means expenses were recognized, but not yet paid in cash, so we add it back. So the operating cash flow equals $100,000 plus depreciation, less increase in accounts receivable, and we add back the increases in accounts payable to receive our final answer of $103,000. So why working capital adjustments matter? This is one of the most tested concepts in accounting and valuation. The logic is based entirely on cash timing. If a current account increases, cash usually decreases. Why? Because cash was used to build the asset. For example, an increase in accounts receivable means that the company collected less cash. An increase in inventory means that the company spent cash purchasing inventory. On the other hand, if a current account liability increases, cash usually increases. For example, an increase in accounts payable means the company delayed paying suppliers, so it's effectively using supplier credit as a short-term financing. So a quick shortcut, or a very useful shortcut, is current assets increase equals use of cash, current liabilities increase equals source of cash. So let's look at a side-by-side comparison. Both methods are allowed under accounting standards, IFRS and US GAAP, and both arrive at the exact same number from cash flow from operations. The difference is only in presentation. The direct method is more transparent because it shows actual cash receipts and payments. The indirect method is less intuitive initially because it starts with accrual profit or the net income, and then we make the required adjustments. However, the indirect method is easier and cheaper to prepare because companies already maintain accrual accounting systems. This is why around almost 95% of the companies use indirect method in practice. So let's build on that. Why most companies use the indirect method. There's several practical reasons why the indirect method dominates in real-world reporting. First, most accounting systems are already built around accrual accounting. Second, the indirect method can be prepared directly from the income statement and balance sheet without additional tracking systems. Third, it provides a clear reconciliation between net income and operating cash flow. This is extremely useful for analysts because it helps identify aggressive revenue recognition, poor earnings quality, or working capital problems. So while regulators may prefer the direct method for transparency, companies overwhelmingly prefer the indirect method for practicality and cost efficiency. So there are some common exam and interview traps. First, an increase in accounts receivable is negative for cash flow because revenue was recognized but the cash was never collected. Depreciation is added back because it reduces net income without reducing cash. Increase in inventory is negative because the company spent cash purchasing inventory. An increase in accounts payable is positive because the company delayed paying cash to suppliers. And to finally remember the most important principle, net income does not equal cash flow. A company can appear profitable on the income statement while generating very weak operating cash flow. So the final summary, let's summarize the key takeaways from this lesson. The direct method reports actual cash collections and cash payments directly. The indirect method starts with net income and adjusts for non-cash items and working capital changes. Critically, both methods arrive at the same cash flow from operations figure. Understanding these concepts is foundational for DCF, valuation, discounted cash flow, financial modeling, credit analysis, and earnings quality assessment. In finance and valuation, profit is important, but cash flow ultimately determines whether a business survives and creates value. In the next model of this corporate finance evaluation series, we'll continue building the accounting and valuation foundation used by analysts, investment bankers, and equity researchers. See you for the next one. Have a nice day.